Have you ever been in a winning trade and felt worse than when you were in a losing one? The trade is going your way. The position is in profit. By any rational measure, this is what you wanted. But your stomach is in knots. You're checking the chart every 30 seconds. Not to confirm the thesis. To check that the green is still there. Your finger hovers over the close button. You know you shouldn't. You know the trade has more to give. But the longer you sit there, the worse it feels. That's profit-taking anxiety, and it costs more accounts than people realize. Today, we're going to build the framework that fixes it. Welcome back. This is episode 13 of the Perp Trading Psychology series, Profit-Taking Discipline. Episode 5, way back in the first arc, covered cutting winners too early at the trade level, the acute moment, the closing of a single position that wasn't ready to close. This episode is different. This is about the discipline that runs underneath every winning trade you take. Most traders never develop it. They have 100 different exit rules for 100 different setups. Pros have one underlying discipline that governs all of them. By the end of this episode, you'll know what that discipline is and the practical rules to install it. Quick explanation. For anyone hearing this term for the first time, profit-taking discipline is the ability to manage a winning position according to a written plan, without your nervous system overriding the plan in real time. It sounds simple. It almost never is. Because winning positions activate a specific psychological pattern that losing positions don't. When you're in a losing trade, your nervous system is in fear mode. You're thinking about damage limitation. When you're in a winning trade, you're in fear mode too. But it's a different fear. You're afraid of giving back what you've gained. The fear of loss and the fear of giving back are different chemicals operating on different timelines. And most traders have only trained themselves on the first one. The second one, the fear of giving back, is the one that wrecks profitable strategies. Because every strategy with a positive expected value has trades that go further than your initial target. If you systematically exit at the initial target, because the giving back fear forces it, you're capping your right tail. And in trading, the right tail is where the asymmetry lies. Let's start with the math. Most traders are trained to think in terms of risk to reward ratios. 102, 103, 194. This is fine for sizing. But it doesn't capture the actual distribution of trade outcomes in most edge-having strategies. In a real strategy, the outcomes are roughly half the trades lose at the predetermined risk, a quarter break, even or scratch out for small wins, and the remaining quarter is where the entire profit comes from. Within that final quarter, there's a smaller subset, maybe one trade in 20, that goes much further than the average winner. If you systematically cut those trades short at your initial target, you've cut out the trades that pay for the strategy. The math of trading is not 102. The math of trading is, most trades don't matter. A few trades matter enormously. Profit-taking discipline is the practice of letting those few trades develop. Let's talk about the neuroscience of profit-taking anxiety. When you're in a winning trade, your brain is releasing dopamine in response to the unrealized gain. But it's also doing something else. It's running a prediction algorithm. That algorithm is asking, what's the probability that this gain disappears? Your brain calculates this in the background constantly, especially during volatile moves. When the probability of giving back rises above a certain threshold, your brain triggers a closing impulse. The threshold is different for everyone, but it's measurable. For most retail traders, the threshold is way too low. They start feeling the closing impulse when the gain is still small, so they close early. For pros, the threshold is much higher. They've trained their nervous systems to tolerate larger, unrealized gains without triggering the closing impulse. How did they do this? Repetition. They've sat in winning trades enough times to know that the giving back fear is usually wrong. The trade usually keeps going, but you can't get that training without first surviving the experience of unrealized gains evaporating, which is psychologically expensive. Most retail traders don't pay that price, so they never train the nervous system, so they keep closing early, forever. There's a specific cognitive distortion in profit taking that's worth understanding: the endowment effect. The endowment effect is a documented psychological phenomenon. Once you have something, you value it more than you would value acquiring it new. In trading, this means once you have an unrealized gain, you feel it as a possession. The possession feels like yours. Losing it feels like theft. This is biologically driven, but it's a profit killer. Because in trading, an unrealized gain is not yours. It's the market's way of telling you the trade is working. If the trade gives some back as it develops, that's normal trade dynamics, not theft. But the endowment effect makes it feel like theft. So you close to lock in the gain, which feels like protecting your possession. But you've just converted a developing edge into a small win, and statistically over enough trades, the small wins don't pay for the losses. The discipline is treat unrealized gains as not yours yet. Easier said than done, but seeing it written down clearly starts the rewiring. Let me describe 3 specific patterns of premature exits. The first pattern, the first target close. Your strategy says exit at 1 half, twin R, or 30 R depending on conditions. You hit 1 half, you exit. This sounds disciplined, but if your strategy actually had a higher expected exit point, you've just cut your average winner. The first target close usually happens because your initial pre-trade analysis predicted 1 R conservatively, but the in-trade development is showing more. Discipline is following the plan when conditions match. Cutting when conditions show more potential is not discipline. It's anxiety. The second pattern, the give-back panic. You're in a 4-hour winning trade. The price retraces 30%. You panic and close at 2.8 R. The retrace was completely normal. The trade was still in your favor. The thesis hadn't changed, but the give-back was emotionally intolerable. So you closed. This is one of the most expensive patterns in trading, because the retrace is often the consolidation before the next leg up, the leg you would have caught had you held. The third pattern, the end of session close. You're in a winning trade. The session is ending. You close because you don't want to hold overnight. If overnight holds are part of your strategy, this is fine. If they aren't, this is also fine. But if your strategy is time frame agnostic and you're closing because the session ended, you're closing for the wrong reason. The market doesn't care about your sleep schedule. This pattern is common with day traders who haven't realized that some of their setups develop on longer time frames. They keep closing at the session end. They keep missing the multi-day move. They keep wondering why their strategy doesn't work as well as backtests suggested. There's a cultural amplifier in trader content that makes profit taking anxiety worse. The take profits is never wrong. Platitude. Trading influencers repeat this constantly. It feels like wisdom. It isn't. The accurate version is, taking profits is never wrong at the right time. The platitude as stated is too permissive. It gives traders cover to close early in any situation by appealing to ancient trading folk wisdom. Pros don't say, take profits is never wrong. They say things like, let your winners run to plan. The difference is the existence of the plan. Without a plan, take profits is never wrong becomes a license to satisfy your anxiety at the cost of your edge. With a plan, profit taking is just executing the plan. There's no wrong or right outside the plan. There's only execution. This linguistic shift from platitude to plan execution is one of the cleanest mental upgrades you can make. There's a leverage angle worth knowing. On Perps, profit-taking anxiety is acutely amplified. A 10x leverage 5% move in your favor is a 50% return on capital risked. That's an emotionally enormous number. Your nervous system tells you to close immediately and protect that gain. But the actual market move is still small. The trade might have 10% more to go. If you systematically close Perp trades early because the leveraged return looks big, you'll never capture the home run trades that pay for the strategy. Pros who trade Perps successfully have trained themselves to ignore the leverage return number and focus on the underlying market move. If your strategy expects a 10% asset move, you don't close at the 5% mark just because 50% return looks impressive. This separation between leveraged return and underlying market structure is one of the most important psychological skills in Perp trading. Without it, every win feels like enough, and you never let the trades that matter actually matter. There's a subtle pattern that traps even disciplined traders. The pre-emptive exit on news. You're in a winning trade. A news event is approaching. FOMC CPI earnings. You decide to close before the event. Lock in the win. Avoid the unknown. This sometimes works, but it's another version of the give-back panic dressed up as risk management. If your strategy didn't include news, event closure rules, you're not following the plan. You're adjusting the plan in real time based on uncertainty. Real news event rules look like close all positions 30 minutes before FOMC, or hold all positions through CPI, or specific predetermined behaviors per event. Without those rules, the news event closure is just anxiety with a justification. The trader who closes pre-FOMC every time because you never know systematically caps their winners, and the news rarely actually moves against them in the way they feared. The fix is write the news event rule in advance, or stop using events as exit triggers. So how do you train yourself out of premature profit taking? I'll give you 3 practical rules. 1. Set your full target before you enter. Then physically separate yourself from the trade. Before you click buy or sell, write down your stop and your target. Both. Specifically. Then place the target as a limit order if your platform supports it. The order sits there. The trade either hits the target or hits the stop. You're not in the loop anymore. This sounds simplistic. It works enormously well, because the closing impulse can't override an order that's already placed. The trader who relies on manual exits is at the mercy of every emotional state across the duration of the trade. The trader who places target orders is protected from themselves. 2. Practice partial exits with predefined ratios. If sitting through full unrealized gain is too uncomfortable, use partial exits. At 1 hour, close 25%. At 20 hour, close another 25%. Let the remaining 50% run to the full target or trail with a meaningful stop. This is a compromise, but it's a useful compromise. You give up some upside on the partial closes. You buy psychological breathing room on the remainder. The trade that closes 25% at 1 hour, 25% at 2 hour, and 50% at 5 hour is much better than a trade that closes 100% at 1 trine. For most retail traders, partial exits are the bridge between cutting everything early and holding everything too late. 3. Journal the, if I had held data. After every winning trade you close, mark where the trade actually ended up over the next 24 hours. Then, once a month, total the additional gain you would have captured if you had held to plan. This is uncomfortable. You'll see numbers that hurt. But the data trains your nervous system in a way that no abstract education can. After 3 months of seeing the held to plan numbers, the closing impulse starts to lose its grip. You see it for what it is, a nervous system reflex. Not a wise observation. The numbers do the convincing. Don't try to convince yourself with logic. Just track the data. There's a flip side worth knowing. Professional traders are not unflappable on winning trades. They feel the same give-back fear you do. What separates them is they don't act on it. They've made an agreement with themselves in writing before the trade started. The agreement is the plan. When the give-back fear shows up mid-trade, they recognize it as a feeling, not as a signal. Feelings are noise. Plans are signal. The pro listens to the signal, not the noise. This is not because pros lack feelings. It's because they've practiced separating feelings from execution thousands of times. The retail trader is feeling and executing simultaneously. The pro is feeling and observing the feeling while execution runs on its own track. The separation is trainable. It just requires the willingness to follow plans, even when feelings disagree. That willingness. The willingness to be uncomfortable in service of a strategy is the actual professional skill. So to summarize today's episode, profit. Taking discipline is the ability to manage winning positions according to a written plan, without your nervous system overriding it in real time. It's hard because the fear of giving back unrealized gains is a separate, often stronger, fear than the fear of taking losses. It's amplified by the endowment effect, which makes unrealized gains feel like possessions. It shows up as first target closes, give back panic, and end of session closes. It's culturally amplified by the take profits is never wrong platitude. And it's acutely amplified on perps, where leveraged returns look emotionally enormous, even for small market moves. The 3 practical rules: place target orders, use partial exits as a bridge to full discipline, and journal the held to plan data. Underneath all of it is the realization that your strategy's edge lives in the right tail. The home run trades. The few positions per year that go further than average. If you can't hold those positions, you don't have a strategy with positive expected value. You have a strategy that breaks even, paid for by the few times you accidentally held. The pro stops accidentally holding and starts deliberately holding. That's the transition. In the next episode, we're going to talk about something that wrecks profit, taking discipline, almost more than any internal pattern. News reactivity. Why FOMC CPI earnings and major political events derail traders who otherwise have functional strategies. What's happening in the nervous system when headlines move you, and the framework pros use to either ignore news entirely or trade it deliberately. Never the fuzzy in between that destroys retail accounts. Appreciate you all for listening. If this episode helped you, subscribe and share with someone who keeps closing the trade right before it really goes. And I'll see you guys in episode 14. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.